Okay, thank you for joining me for the Be the Business Bee BUSS1 live revision. However, this isn't a revision live, this is actually pre-recorded because the live show had a few technical errors, so I've decided to record it for you again so you can watch it back in your own time. You may want to use a student resource guide which you can find on bebusinessbee.co.uk. This guide has got a student resource pack which you can use throughout the session to try and help you build up your notes. If you have any questions, feel free to tweet me and I'll respond to them at any one time, so no problems with that at all. Let's just go and get rocking and rolling. Like I say, it probably help if you have got the student resource guide. Feel free to pause this video at any time you wish to so that you can complete any of the activities. I'm going to look at today. I'm going to look at first about the exam requirements of BUSS1. Then we're going to look at the sources of finance that exist for business. We're going to look at your cost, revenue and profit. Break even will be for number 4. Then we'll look at cash flow forecasting. Then we're going to look at some budgeting. I've got a quick quiz for you. And then you can ask any questions at the end and tweet them away to me. Then that's going to get us going. Okay, let's go straight into looking at the BUSS1 exam and the requirements of the BUSS1 exam. The BUSS1 exam is planning, financing a business. It's 40% of your AS and 20% of your A level. It's a 1 hour and 15 minute exam, which is 60 marks in total. It's short answer questions and extended response questions, which are all based on a mini case study that you're going to take and do. Okay, you may want to use a student resource pack. Like I said, you can find it on our website, bebusinessbee.co.uk. And you've got a game in there. You've got a business bingo card. I would like you, on your card, to write down, quite simply, any different sources of finance you could use to set up a brand new business. You may want to pause the video now while you complete that. Okay, I'm hoping that on your card you've got some of the following. I went for personal savings as my first one. Then I went for family and friends as my second source of finance. Sale of shares. Bank loan. Overdraft. And venture capitalist. That for me would give me a full house. See if you've got a full house compared to that. You may have some other ones. If you wish to, feel free to tweet them to me at bebusinessbee and I'll look over them for you. But I'm assuming you will have probably 6 sources of finance. Okay, what I'd like to do now, in your booklet you will notice you've got a table. I would like you to see if you can, for each of those sources of finances that I've listed there, so personal savings, family and friends, sale of shares, bank loan, overdraft and venture capitalist, see if you can give me an advantage and a drawback of each source of finance. You probably want to pause the video while you complete that. Okay, let's have a look at some of the answers. So personal savings are quick and easy to obtain. However, a drawback could be that you don't have access to large sums of money that you need. Family and friends, the obvious advantage, you don't need to pay them any interest. However, a drawback could be that it could lead to potential conflict if you fall out over this. Sale of shares could be a great one because you can raise large amounts of capital and you don't pay any interest on it. However, a potential drawback is you have to pay a dividend, so share your profits, and you are potentially selling control in your business. A bank loan, an obvious advantage, you can get large sums of money that you can obtain quite easy. However, the drawback tends to be that you have to pay interest on the money that's borrowed. An overdraft is a short-term source of finance, which is quite a good advantage when you need to access some money to solve a cash flow problem. However, it's an expensive form of borrowing with a higher interest rate than a bank loan, so that's a drawback. A venture capitalist, that's like Dragon's Den, when you see them on Dragon's Den. It's a quick source of capital when others may have refused, a bank has refused, or maybe family and friends that lend it you. However, a drawback to this tends to be that you're actually selling control in your business. Okay, let's move off sources of finance and let's go on to revenue now. So revenue, costs and profits. So revenue is all the money that comes into a business from selling products or service. Typically, revenue is calculated by the number of items sold multiplied by the selling price. You should know this formula. You need to learn it. Okay, what I'll do is, in your booklet, you've got this little section. Now, I'd like to have a go at trying to calculate the revenue for the following company. A car company sells 10 cars a month, each with a selling price of £20,000. What is a monthly revenue and what is a yearly revenue? You may want to pause the video while you complete this in your booklet. Okay, you should have the following answers to the questions we just asked you. The monthly revenue should be 10 times £20,000 for each car, which gives you £200,000 in total. The yearly revenue should be 12 times 200,000, because obviously 12 months in a year. So 12 times each monthly figure would give you £2.4 million. Hopefully you got those correct. If so, that's fantastic. If not, have a look at how I calculated them and try and work it out. If you're still stuck, tweet me and ask any questions and I'll give you a hand and help you out. Let's have a look at some costs. Right, now costs are typically the outgoings from a business and an organisation. Typically we split costs into 3 different categories. We have 3 different types of costs. They are fixed costs, variable costs and startup costs. Now the key word here is the bit about output. Fixed costs do not change with output. So if you make more products, these costs still remain the same. This is like rent. If nobody comes into your shop, you still have to pay rent. If 100 people come into your shop, you still pay the same amount of rent. The rent does not change. Variable costs do change with output. These are costs directly linked to your production. These are costs that are linked to producing your product. For example, these are the raw materials that go into making your product. Startup costs are one-off costs. These are the costs that only apply when you set your business up. So these are the one-off costs that you have. Now remember, the key part of this is all about this word changing with output. Fixed costs do not change with output. Variable costs do change with output. Okay, in your booklet you've got an example table which is blank at the moment. You may want to fill these in. So these are different types of costs that exist. So let's get fixed costs. Remember, these don't change with output. So rent, you pay all year the same amount of money throughout the year. It's a fixed cost. Salary, it's a fixed amount of money you earn from you doing your job, so it's paid by the year. Broadband internet, you normally pay a fixed amount of broadband internet. Insurance, again, that tends to be fixed. You pay it up front at the start of a year. Variable costs could be raw materials, so the items that go into producing the product. So these are things that do change the output, remember. Wages, paid by the hour, so the more hours you work, the more you earn. The telephone bill, the more telephone calls you make, the more you actually pay on your bill. The electricity bill, the more electricity you use, the more it's going to cost you. And then you've got startup costs. Now in a typical shop like I'm using here, you've got things such as shelving, signage, a till, decorating. These are sort of one-off costs that you won't actually come up against all the time. Okay, move on to looking at profit. Now profit is the amount of money that a business makes. A simple formula to learn is revenue minus costs. Now there's 2 types of profit. Gross profit is what we call the largest profit. This is the biggest one you make. Think of the word gross meaning fat, big. Right, now this is the amount of profit you make on every item that you sell. So for example, if you sell a book at £3 that costs £2 to print, the gross profit per item is £1. Right, now the formula to calculate this is revenue minus the cost of sales. It's really important that you learn this. So remember, gross profit is revenue minus cost of sales. At this point now, you should not be making a loss, because this is how much you make on every item you sell. Now, the next type of profit is what's called net profit or operating profit. Now, this is the final profit that a business makes. This is the one you see. This is typically the smaller figure. This also could be a loss. Now, this takes into account all costs. This takes into account all fixed and variable costs. And the formula to calculate this is revenue minus all costs. This is always a smaller one. This is the final figure you take home with you and get to see. So that's a net profit. Now that concludes our costs, revenue and profit section. We're now going to look at break even. Okay, break even is a point where a business is making neither a profit nor a loss. It's making a big fat zero. Break even is really quick and simple and easy tool that you can use with business planning. However, its accuracy is always dependent on the person who is conducting it and the external factors remaining the same, so the economy not changing, making sure that costs and inflation don't change. So it's assuming quite a lot is staying the same, which of course we know is not going to be the case. It's also very difficult to calculate if you've got more than one item. It's very difficult to do it on average, because you're then taking an average figure which could be skewed or distorted. However, let's take a look at break-even and what you need to know. You need to know the formula. Now the break-even formula is fixed cost divided by contribution. This is a selling price minus a variable cost. Quite simply, the contribution is how much each item that you sell contributes towards your fixed costs. And it tells you how many items you have to sell to break even. We'll have a look at this contribution in more detail in a minute. We'll get to an example. What I'd like you to do for me now, in your booklet, got this, is calculate the break-even point for the following 2 businesses. So you've got business 1 on that side over there, and business 2 on this side over here. Notice the only difference here is this one's doing variable cost per unit, which is where the formula is set up. So remember, fixed cost divided by the selling price per unit minus variable cost, where this one over here has got totals. But I told you they sell 4,000 items, so you need to work that out to get it into cost per unit. Pause the video now and have a go at completing that, finding the break-even for both businesses, and then we'll take a look at the answers. Okay, the answer for the question 1, as you see on that side, is 1,250. Dead easy calculated. 2,500 is our fixed cost divided by our selling price, £6, minus £4 variable cost per unit, gives us 2,500 pounds divided by 2, 1,250. Now, answer B is a little bit more complex. You've got to find it per unit. So it's £50,000 divided by the 4,000 units you make, which gives you an average £12.50 per unit. Then it's the variable cost per unit we've got to find. So that's the 30,000 divided by the 4,000, which then gives us £7.50 variable cost per unit. Then we pop it into our figure, our £75,000 fixed cost divided by our selling price per unit of £12.50 minus our £7.50, which then would give us 15,000 units. Now we can use this to work out our contribution. You know about contribution I mentioned earlier? This is this part here. Look at this one here. This is how much each item contributes towards each fixed cost here. So the £6 minus the £4 means that every item we sell here, we make £2. So how many £2 contribute towards this 2,550? That is all the contribution is looking at. Now sometimes break even is done with a chart. Now it's unlike in the exam they would ask you to draw a chart. They're probably going to ask you to finish one off or complete it, or mark on it some point. So let's take a look at a break-even chart. You've got one of these in your pack. What I'd like you to do for me is try and mark on the break-even point. Also, try and mark on the margin of safety, assuming the business is producing 800 units. What is their margin of safety? What would happen to the break-even point if A, we increase the selling price, and B, we increase the variable costs? So mark these on, think of the answer to those questions, pause the video now, and then we'll have a look at the answers next. Okay, I'm assuming you've all marked on the point where it crosses here. So this point here is a break-even point, which is 600 units. Now, hopefully, you know the margin of safety is a difference between the actual output and the break-even output. So we know the actual output is 800 there. I've marked it on there. And we know the break-even output is 600. And I've marked it there. And the difference between these two here is 200. So the margin of safety at the moment is 200. So let's then take a look at an example here. So if we increase the selling price, what would we expect to happen to the break-even point? Well, hopefully, we'd hope the break-even point would get and reduce itself, so it would come down maybe to 500 units down here. So imagine that's 500 there. What's happened to our margin of safety? It's got bigger. We've now got a margin of safety of 300 units. Of course, on the other hand, what would happen if we increase our variable costs? Well, if we increase our variable costs, that's going to make our margin of safety get shorter, so perhaps our break-even point might be 700. So imagine there, our margin of safety now becomes only 100 units. Now bear in mind, this area here is what we always call the area of loss, and this area up here is what we call the area of profit. Notice that every break-even chart has to have a title, it has an axis labelled, and it has the points marked on with a key. These are all key things to do to ensure you maximise the marks you can get in the exam. Okay, hopefully break-even is fairly straightforward, you're understanding that. If not, drop me a tweet and I'll help you out with that. We're now going to move on to cash flow. Now, cash flow are the inflows and outflows of money in a business. This is typically one of the most common causes of a business's failure. Now, cash flow, typically, when you think about it, has got different terms that get used in the exam. They ask questions quite a lot at the start of the exam about defining these terms. A cash flow forecast is a prediction of the inflows and outflows of money in a business. So remember that, it's a prediction of the inflows and outflows. A cash flow statement is the actual flows of money into and out of a business. Make sure you know those and don't confuse me in the exam because it's throwing away easy marks. So what does cash flow look like? I've taught all my students to think about cash flow as being a bathtub, as you've probably well seen here. Now, every bathtub has got a plug hole and it's got taps. Now, in this example here, the inflows are the taps, so money coming into business, and the outflows, the expenditure, the costs, the variable and the fixed costs are down the plug hole and out there. And water in the bath is actually money in the bath. So obviously the more money in the bath, the better the business is doing. Remember, if it's got too much money in there, it could be bad because it's overflowing. It might be wasting the money. It's not investing it and doing something with it. So that could also be a bad sign. So we need to think about what we want to do to try and solve a cash flow problem, or what we need to do to manage a cash flow. Now, too little cash in our business down here means we've got a liquidity problem, and that could lead to bankruptcy, and that can cause problems. So we don't want to do that. Now, that could be because we've got too much water running out of our bathtub, too many costs in the business, or we're not injecting enough revenue in to cover the costs that we've got. Now, notice I've got a hot tap and a cold tap. The cold tap is sales revenue. That's good revenue. That's sales, selling of products. The more we put in there suggests we're doing well. If we can sell more products, we put more money in. So that's good. If we can fill our bathtub up with blue water, that's really, really good because it's money from sales, suggests we're doing well. Now, the red tap is the hot water tap. It's a bank loan or the borrowed sources. Now, if we start filling our bathtub up purely with hot water, just imagine what's going to happen. You've all been there. You put your finger or your toe into your bath. It's red hot. You scream with pain and agony because you get burnt. And that's exactly what a loan does. It burns you because you've got to pay back interest. And that interest, in the end, theoretically, just makes these costs wider. You're making your plug hole wider, so you're just draining more water out. But not only are you draining out water, this time you're borrowing the money and draining out borrowed money. So you're not solving the cash flow problem. So typically, there are only two solutions to a cash flow problem. And those are quite obvious. One involves your inflows, one involves your outflows. So you either reduce your costs, so make your plug hole smaller, or you increase the level of sales that you've got, i.e. make your revenue tap, your cold one, turn it on, make it quicker. You should never ever turn on the hot water tap borrowing money to solve a cash flow problem, because that's going to lead to long-term failure. Okay, in your exam booklet that I've made for you, the little pack I've made for you there, you should have a cash flow forecast. What I suggest you do is have a go at filling it in. You should see blanks. So, hopefully you can fill these in nice and simply. Look at the pattern, try and work it out. Probably want to pause the video now, and then we'll come back to have a look at the answers in a minute. Okay, hopefully you've got some answers, and I'm hoping your answers are quite straightforward. So you should have 10,100 goes in there. It's just these two added together. This one here, down here, you could do it two ways. The first way, and easy way, is it's a fixed cost, it's rent, so it should be 1,000. Or you could technically add up these numbers here, take them away from this total one here, and you get the same number there. Exactly the same pattern here. It's a salary, so you should know it's fixed, so it's going to be 2,000. However, you could add up these numbers here, take them away from this number here, your total outflows, and you get the answer there. Down here is a little bit more complex. Net monthly. Net monthly is your total inflows minus your total outflows. So, of course, all you've got to do is take that away from that, and you should get minus £3,050. And, of course, that then, when you add your opening balance to your net monthly, you get your closing balance. And, of course, last month's closing balance becomes next month's opening balance. So then you should have £3,075 going up there. And that will complete your cash flow forecast. Hopefully, you got that right. If so, well done. And you've now completed cash flow. We're now going to move on to our last topic we're going to do today, which is budgets. Nice and simple. Have a look at these. Okay, a budget is a financial forecast of the inflows, outflows, and profits in an organisation. We typically have three different types of budget. We have an income budget, an expenditure budget, and a profit budget. The income budget is a prediction of all the inflows in the business. An expenditure budget is a prediction of all the outflows in the business. And a profit budget is a prediction of how much profit we're going to make. Some typical questions you might see. So what are the advantages of a business conducting budgeting, and what are the drawbacks of a business conducting budgeting? Typically, the advantages of doing budgeting are it's a great way to plan for the future. You can see what you might need to use for expenditure. It's also a great way to control your finance and your expenditure. So it's a good way to see how you're doing financially and if you need to borrow any money. It's also a great plan for the future. So you can plan how you're going to spend your money and what you're going to use it on. And it can also be used for management strategy decision. Do you want to spend money on that particular cost centre, that profit centre? And how are you going to tighten up the expenditure in the business? Of course, the potential drawbacks can actually be, it's only an estimate. Purely and simply, you are predicting, you're guessing. It's based on how accurate the guesswork is of someone else in the business. How accurate are they at predicting the expenditure? It's also could be a method which demotivates. If you get the accuracy incorrect, you could be demotivating some of your workforce. And of course, that's where your smart objectives come in, something that's critical to success for a business. Okay, setting a detailed and accurate budget requires following a set process. Now, to get this process right, you really need to think about where you start from. So you've got to start with the company objectives. What are the objectives of the organisation? When you've got these, then you need to think about gathering information, so conducting some market research. So finding out what the current demand is for the product and also what's happening to costs, for example, in the market at the moment. When you've got these, then you start to conduct your budget. So then you can do an income budget, an expenditure budget, and a profit budget. And then you've got your budgets now. It's not going to stop there. You're going to keep reviewing them, looking back at them. How are you performing against them? Keep checking back. Good management is always about looking at the figures and accurately reviewing them and making adjustments, using past data to see how you're performing. Now again, realistically in the exam, you're not going to be asked to conduct a budget from scratch. So what I've done in your booklet is I've given you these 3 budgets here, an income budget, an expenditure budget, and a profit budget. What I'd like you to do is probably pause the video now and have a go at completing these. Okay, hopefully you've got the answers for me. The first one here, the income budget should be £10,000 down here, adding these together. The expenditure budget should be £4,800, adding these all together here. And carrying this figure here and this figure here and put it into your revenue and expenditure budget should give you £10,000 up here, £4,800 up here, and gives you a total profit or loss of £5,200. See on the screen, there you go. There's the answers there. Nice and simple. And that concludes budgeting. Here's a little quick quiz for you. Have a go at these questions. See if you can answer the questions for me. What is the break-even formula? What is a cash flow forecast? What is an adverse variance? So getting you to think about BUSS2 already. So trying to push you ahead there. Think about BUSS2. What is an adverse variance? What is a formula to calculate gross profit? List 3 sources of finance. Give an advantage and drawback of each source of finance that you've got. And then try to explain how budgets can help a business be successful. If you can answer all those questions, then I think we've had a successful revision session. If you've got any questions, feel free to post them under this video. Tweet me at bbussb. Check out my website, bbussb.co.uk. Thank you for watching the session. Hopefully you found revision session useful. Remember, I've got the resource pack on my website. Don't forget to give me a follow on Twitter. Subscribe to the YouTube channel. And check out the website. And like I say, I'm going to hang around and ask me any questions you need to. So feel free to do that. Either use a hashtag BBB or alternatively, it's probably much better to actually use at bbussb. Thanks for joining me today. And hopefully you can join me on Friday for the live revision session without any technical problems.